Hello and welcome to the first session of the tax module. Today and for the next 3 days, we will have with us Oliver Hoare. Oliver is a tax professional for almost 20 years and an author of several articles and books about taxation as well. Please do not forget to rename yourselves by using your full name. Also, do not hesitate to ask your question by using the chat function, and Oliver will answer all of them by the end of the presentation. All the sessions will be recorded and you will have access to them in the end of the module. Welcome, Oliver.
Thank you, Avi, for that introduction. So I wonder, do we still wait a moment, as I think we are still expecting some people, or do we begin?
Yes, we can wait one minute.
Let's wait one minute in order to have everybody on board.
Sure, no problem.
Good day, everybody, and welcome to today's webinar. It's today the first of 4 webinars on structuring private equity investments in the post-BEPS era, so with a focus on taxation. So the first webinar today will be focusing on structuring aspects. Tomorrow's webinar will be focusing on substance requirements. The webinar on Thursday will focus on transfer pricing aspects. And on Friday, we will have a session on Tax 6 and reporting obligations of intermediaries. So this series of webinars is meant to provide you with an 360-degree overview of all relevant aspects when it comes to private equity investments made via Luxembourg. Apart from this presentation, we also will provide you with a handout if this did not yet happen, which also includes a number of selected publications that provide further information on the topics discussed during the presentation. Yeah, so today's presentation will have 2 main parts. So first we will speak about typical investment structure in private equity and real estate. I saw that we have a fairly diverse group of participants, so I will describe how we are typically structuring investments and what are the key considerations when structuring investments. And then the second main part will focus on the impact of the anti-tax avoidance directives on private equity investment. And there are mainly 2 topics that will be discussed, like the interest limitation rules and the hybrid mismatch rules.
Oliver, sorry, excuse me.
Yeah.
If you have something else open, like another file, we can see that there is a message in your slides.
Yeah, I see that too.
So yes.
I do not have anything on.
Yeah, because you're sharing only this file, so we can see this message. But it's okay if there is nothing.
So now it goes away, but I mean, I definitely have nothing open here, but.
Maybe you can reshare. Stop sharing and
okay.
Reshare. Thank you.
So now it works?
Yes.
Wonderful. Okay. Probably just to begin with a little background about where we come from. So it was in 2013 when the OECD launched its base erosion and profit shifting BEPS project. Then 2013 until 2015 was quite an active time. I mean, we had all these discussion drafts on 15 different BEPS actions. Virtually no stone in international taxation remained unturned. Then in October 2015, the final reports have been released on the 15 BEPS actions. Apart from there have been some follow-up work being done in the meantime. And now all the results of this work on the BEPS project has been implemented in the meantime. I mean, we had in Europe 2 anti-tax avoidance directives, ATAD 1 and ATAD 2. Then the OECD Model Convention and the related commentary has been amended in 2017. Bilateral tax treaties have been amended via the multilateral instrument that entered into force in 2018. Then also the transfer pricing guidelines have been amended one time in 2017, and in 2020 we had new guidance being released on transfer pricing aspects of financial transactions, which is obviously quite important for Luxembourg, where Luxembourg companies are mostly say like involved in financial transactions. And then in Europe we also had like DAC 6, which introduced the mandatory disclosure regime, which was also something developed during the say like BEPS project. And so that say like since 2013 we witnessed an extreme legal uncertainty because one did not know where to go, and it was obviously also political movement, if I may call it like this, and so you do not really know where things would be landing, you know, when you have like say like political ideas coming into the tax sphere. However, now after say like we have now all this guidance, say like certainty is coming back, and we see more clearly say like how all this falls together. So now having a look at typical investment structures, and so here we have a private equity investment with a Luxembourg fund. So the Luxembourg fund would typically invest via a Luxembourg master company. That's a standard fully taxable company, like a SOPAFI, maybe in the legal form of a SAL. And Lux Master Co invests into local bidcos that then acquire the operational companies. Then one would finance the local bidco that can also be financed by third-party debt, obviously, with a mixture of equity and debt in accordance with the tax rules applicable in the residence state of the bidco. Local bidco that would be in the investment jurisdiction. And so then we would finance local bidco with an interest-bearing loan, IBL, and equity. Then at the level of the Luxembourg Master Company, we would finance the loan that is granted to the local bidco by a loan granted by the fund. Here, Lux Master Co would typically have the function and risk profile of a finance company and would need to realize an arm's length finance margin. This needs to be determined in a transfer pricing study. And then with respect to the financing of the participation in the local bidcos, here Lux Master Co could be financed by various equity and debt instruments. Here we are showing like a mixture of equity funding and the funding with convertible bonds. Convertible bonds say like bear fixed interest and can be redeemed at fair market value. So that means if Lux Master Co realizes a big dividend from one of the investments, then it could say like, I redeem a certain amount of convertible bonds at fair market value in order to repatriate the cash to the fund, and this repatriation would not be subject to withholding tax. But there are different financing instruments and strategies, and we will discuss about that later. So that would be a Luxembourg fund structure. Now looking at a, say like a foreign private equity fund investing via Luxembourg. So here we would have, like a foreign fund vehicle, could be Cayman, for example, investing via a Luxembourg master company that functions as a Luxembourg investment platform into the local bidco that in turn invest into the operational companies. And here again, the same consideration. So the local bidco would be financed with a mixture of equity and debt in accordance with the tax rules applicable in the investment jurisdiction. At the level of Lux Master Co, the interest-bearing loan would be financed by a debt instrument granted by the fund. And here Lux Master Co has to realize an arm's length remuneration. Here I'm indicating PECs, which are preferred equity certificates. So that is an instrument that has been more used in the past because of say like the particular tax rules applicable in the United States in case of US-driven funds. And then with respect to the financing of the participation in local BidCo, here again, one has a whole range of equity and debt instruments that one can use in order to finance participations. Here I'm indicating convertible preferred equity certificates. These instruments have more or less the same features as a convertible bond, as much as the preferred equity certificates are pretty much the same as an interest-bearing loan in terms of mechanism. And so the CPECs would normally bear fixed interest at arm's length and could be redeemed at fair market value. And this redemption at fair market value would not be subject to Luxembourg withholding tax. Here, obviously, as we can feel it already, like with the PEC instrument, we need to give some consideration to the hybrid mismatch rules, as we will discuss about later. Now looking at real estate investments. So now we have here a Luxembourg real estate fund that invests via Luxembourg Master Co. into Luxembourg or local property companies. So here, whenever we can, we use a Luxembourg property company, like for example in Germany, that's beneficial because one eliminates some concerns that one may otherwise have. For example, when we have a Luxembourg property company, we do not need to think about German dividend withholding tax, which is very positive if one can avoid this discussion. And on top of that, the Luxembourg property company would only be subject to German corporate income tax and not to corporate income tax and municipal business tax. That makes a difference of 15% versus circa 30%. So that is one jurisdiction where Luxembourg property companies are very reasonable to choose. And so this property company would be financed by a mixture of equity and debt funding in accordance with the rules applicable in the investment jurisdiction. So then again, we have our interest-bearing loan here, and we would finance as much interest-bearing loan as is appropriate in accordance with, say, like foreign tax rules, because even if you have a Luxembourg property company, we are subject to the tax rules applicable in the CETO state of the property. Then at the level of Lux Master Co, the loan granted to the property company would be financed by a loan granted by the fund. And here Lux Master Co would need to realize an arm's length finance margin. And then again, the same applies with respect to the financing of participations. Here we have a broad range of different instruments that we can use. And so you see, like, yeah, whether private equity or real estate investment, it all looks more or less the same. I mean, obviously this here is also a simple structure. In practice, it might be a bit more complicated. One might have like additional layers of companies, but this is often driven by other, say like, by other drivers, such as having a joint venture or having bank guarantees, and therefore one needs different levels of entities. But this here is pretty much like a straightforward investment structure. Then quickly the foreign real estate fund, and now I will not speak about that in detail anymore. I mean, it looks pretty much the same as the Luxembourg fund, just that we have a foreign fund vehicle and potentially other financing instruments. Now going a bit through the rationale of how to structure investments in Luxembourg. So I mean, first speaking about the tax regime. So if we have Luxembourg companies like here Lux Master Co, that would be a fully taxable company at a tax rate of approximately or nearly 25%. Up to 150,000 of taxable income, it's 23%. The Lux Master Co would benefit from tax treaties concluded by Luxembourg and EU directives. Yeah, and otherwise, yeah, would be fully taxable. But then we will see afterwards there are also exemptions available. And when we speak about the fund in the form of a reserved alternative investment fund or a specialized investment fund would either not be subject to Luxembourg taxation, corporate income tax, municipal business tax, and net worth tax, or would be exempt from that tax. However, a Luxembourg fund is subject to a subscription tax of 1 basis point applied on the net asset value. So that are the vehicles that we are using. And then when looking at the level of Lux Masterco, the taxable entity. So, I mean, first of all, this entity is performing holding activities. Here, the income derived from the participations, meaning like dividend income, capital gains, and liquidation proceeds, would generally benefit from a full exemption under the Luxembourg participation exemption regime. That means like all the income that we receive in regard to the participation should be tax exempt. So therefore, in this respect, the question is not, do I have like expenses in order to offset taxable income? The question is only, how do I repatriate the cash to the fund, free of Luxembourg withholding tax? Then, on the other hand, we have financing activity. Here, typically, Lux Masterco would take the select function or have the functional risk profile of a Luxembourg finance company, and therefore Lux Masterco would need to realize an arm's length finance margin. So the interest income would be fully taxable, but the interest expenses incurred on the loan granted by the fund would be deductible, and therefore Lux Masterco would only be subject to tax on the finance margin. When we have a chain of companies where the loan is granted through the chain, we do not need to have each and every entity having the functional risk profile of a finance company. So there it might be that then we have like one finance company and other entities that do not take any risk in regard to the on-lending of funds, having the functional risk profile of an intermediary. These would only need to realize then a small cost plus remuneration. Which brings us to the next topic, transfer pricing. Transfer pricing is now the hot topic in Luxembourg, because when we speak about taxation, I mean, say like the application of tax rules is normally fairly clear, but where question marks may arise is, what is the right level of remuneration, for example, for a loan or for the financing activity? And therefore, while in the past we have typically mitigated tax risks through obtaining tax rulings, today we need to produce like robust transfer pricing documentation in order to mitigate any tax risk. And we will have a full session on Thursday on transfer pricing. Another important topic is substance, because Luxembourg companies need to be equipped with appropriate substance. So that doesn't mean excessive substance, but appropriate substance. And there also we will have a separate session tomorrow on why or for what reasons we have substance requirements and what is an appropriate level of substance. And then the last topic, DAX 6. So like that's a fairly new topic since so like 1st July last year, the regime entered into force. But the first reporting obligations were at the beginning of this year, and DAX 6 refers to the mandatory disclosure regime, where intermediaries that are service providers that are rendering advice in regard to tax structuring potentially need to make reportings in regard to certain cross-border arrangements if they fulfill certain conditions. And that is something that we will speak about on Friday. So then, looking at one key topic, when structuring private equity investment, it's always about an efficient cash repatriation. So it's about having flexibility in terms of cash repatriation and being able to repatriating to the fund free of Luxembourg withholding tax. So I mean, typically, like the thing is like a standard dividend distribution by Lux Masterco to the fund would be subject to 15% withholding tax. So therefore, we are typically financing, say, like Lux Masterco by a mixture of equity and debt instruments. that allow the repatriation of cash free of Luxembourg withholding tax. And now looking at the different debt instruments that are available, while different firms put like different labels and different names on the instruments. In principle, there are like 4 categories of debt instruments. So we have like interest-free instruments, like interest-free loan. We have interest-bearing instruments, like a general interest-bearing loan. Then we have convertible instruments, like convertible bonds or convertible PECs. And then we have like tracking instruments or income participating instruments or profit participating instruments that would track a certain percentage of the underlying income. Then looking at an equity instrument that is commonly used in the context of private equity investment, it's classes of shares that can be redeemed, say like at fair market value, and would then be triggered as a partial liquidation, and a partial liquidation is not subject to Luxembourg withholding tax. So that means, yeah, we have here different instruments available, and then one need to think, and today we need to think in a much more tailor-made fashion than in the past, where people have been structuring investments always in the same fashion. I mean, today one need to ask oneself the question like, yeah, what is the lifetime of the investment? What are the expected amounts of cash to be repatriated in the form of dividends or capital gains to Lux Masterco, in order then to know like how much cash do we need to repatriate by Lux Masterco to the fund. And then one need to create enough flexibility and cash repatriation capacity in the structure in order to be prepared for any moment, you know, or whatever unexpected scenario might happen, that we have the possibility to repatriate the cash to the fund. Because one thing is that probably changed compared to the past. I mean, say like 10 years ago, if one did not foresee something on day one, and one then needed to do a restructuring, that was much easier and much more unproblematic than today. Because if today you do not plan it as from the beginning, trying then to create additional flexibility at a later point in time is not so easy, and one always have like questions around like probably abuse of law and this kind of stuff. So therefore, one need to give due consideration to that on day one. Then, if you look to ATAD 1 and ATAD 2, while there are some more rules that have been implemented now, when we look at private equity investments and real estate investments, the 2 rules that are most important are the interest limitation rules and the hybrid mismatch rules that will be considered now in the second part of the presentation. Yeah, so beginning with the interest limitation rules. So some countries already had interest limitation rules before ATAD came in, like Germany and France. So Luxembourg now introduced interest limitation rules as from 2019 in accordance with ATAD. Interest limitation rules aim at limiting the deductibility of interest expenses. And these rules apply to internal debt, but also to external debt. And so in principle, there is a fixed ratio rule that means up to 30% of the EBITDA exceeding borrowing costs can be deducted. So that's the basic rule. Then we have a carve out from that, which is a group ratio rule. So if the group is heavily indebted, then also individual members of the group can deduct a higher level of interest. However, this is not relevant in the context of alternative investments. Then one important rule is the safe harbor rule, which provides a 3 million safe harbor. It means up to 3 million. One has no restriction whatsoever on the deductibility of interest expenses. And with respect to loans that existed already before the directive ATAD 1 has been adopted, meaning 17 June 2016, would not be concerned by the interest limitation rules. So there would be a protection for old loans. Now, looking at the scope of these rules, so we are speaking about exceeding borrowing costs. So that means like I incur more interest expenses than I have interest income. And so this amount of exceeding borrowing costs could then be subject to limitations in terms of deductibility. Then the question is, what are borrowing costs? And here we have a very broad scope. I mean, they really tried to virtually catch anything in this scope of borrowing costs. On the other hand, there's no definition of interest income and economically equivalent revenues. But, and this has been clarified now also in a circular that has been issued at the beginning of this year, that the understanding of interest income should be the same as borrowing costs, meaning a broad understanding. Then the interest limitation rules are excluding some financial undertakings from the rules, and as already mentioned, there's a grandfathering rules for loans that have been concluded before 17 June 2016, and an exception for long-term public infrastructure projects. But this should also have very limited relevance for alternative investments. So probably just like one word on the grandfathering rule. I mean, to the extent the loan is not amended, the loan is excluded from the scope of the interest limitation rules. So, and here also the circular provides some clarity on what is meant by subsequent modification. So it means, for example, if one concluded a facility agreement before 17 June 2016 and say like Lux Masterco then made additional drawdowns afterwards, all the amounts would be protected by the safe harbor or by the grandfathering rule. And and so like if there are such old loans, it's always worth to have a look whether this grandfathering rule could apply. Then the question is, what happens if I have either exceeding borrowing costs that are not deductible, or I have a situation where I could have deducted more interest expenses than I actually did. So in the one case, one has non-deductible exceeding borrowing costs. In the other case, one has like unused interest capacity. And here the interest limitation rules provide for carry forward mechanisms. So the exceeding borrowing costs can be carried forward without limitation in time. The unused interest capacity can be carried forward for a period of 5 years. So that's quite positive, but say like in practice, if in the context of alternative investments or other contexts, one relies on that, one probably did something wrong, because normally one should structure investments in a way that one does not really fall into these categories. Then looking about the practical impact of the interest limitation rules on our private equity investment structure. So looking here again to our Luxembourg fund structure with the Luxembourg master company financing the local BidCo. Say like we have loans of like 100 million granted by the fund to Lux Holdco and by Lux Holdco to the BidCo. And here Lux Holdco need to realize an arm's length finance margin. That means, say like Luxco realizes 5.2% of interest, and the arm's length finance margin would be 0.2%, and then the fund would charge 5% under the loan granted to Lux Holdco, and here Lux Holdco would realize an 0.2% margin. Since we have like more interest income than interest expenses, we do not have exceeding borrowing costs, we have exceeding interest income. And therefore here, as far as it concerns financing activities, we do not have any concern with the interest limitation rules. Looking now at holding activities. As mentioned before, if we have here Lux Holdco owning a participation in the local BidCo, the income derived from this participation should benefit from the Luxembourg participation exemption regime. That means like all the income is fully tax exempt, dividends, capital gains, liquidation proceeds. So it means here the costs incurred in relation to the participation are generally not deductible for Luxembourg tax purposes because there are expenses incurred in relation to tax-exempt income. So we only could have the situation that if in a year we do not realize any dividend income, but we incur costs in that year, then we could deduct this cost, but this cost would be subject to recapture. So it means like a future capital gain would not be exempt to the extent we deducted costs throughout the lifetime of the investment. So that is a particularity, becomes probably too complex for here, but just in general to say that if you speak about interest expenses, say like that what was before not limited in terms of amount, because I mean before if we had like 10 million of interest expenses in relation to a participation, and we didn't receive dividend income in a given year, we could deduct the 10 million and this 10 million would be subject to recapture. Today, that would be limited to approximately 3 million, the safe harbor. However, this limitation in regard to holding activities is not really relevant in practice because in any case, we do not really rely on deductibility of interest expenses in relation to holding activities, because the income is tax exempt. Here it's mainly about the repatriation of cash free of Luxembourg withholding tax. And so the interest limitation rules and later on the hybrid mismatch rules do not have any impact on the withholding tax treatment of a payment. Now, like one investment type, a little excursus investment into distressed debt, might give rise to concerns when it comes to the interest limitation rules. So if you see here now, like, a fund investing via Luxembourg company into a portfolio of distressed debt, and here being financed by a tracking loan, the tracking loan would say, all the income from the distressed debt portfolios tracked minus an arm's length remuneration for the activities performed by the Luxembourg company. And in this very case, we could have an issue with the interest limitation rules because the income derived from the distressed debt portfolio would typically be capital gains and not interest income. And when we realize capital gains that are not to be classified as interest income or economically equivalent income, then we would have the limitation to 30% of, say, like the taxable income derived from the debt portfolio. And if then 70% would be subject to tax at a rate of 25%, that would leave us with an effective tax rate of approximately 17%. That would obviously not be so beneficial here. And therefore, one need to think about how to manage that. And that was probably the key concern when the interest limitation rules have first been provided in draft law and then been implemented. However, now, like speaking about some solutions, so there's one thing that one could think about in terms of accounting treatment. I mean, if it's possible to treat the income as interest income for accounting purposes, then tax would follow accounting. And there's even in regard to investments in distressed debt, it is said, yeah, if we have the expectation to make a certain amount of income in regard to the distressed debt portfolio, then we could book that as kind of a deferred income. And then as we realize capital gains, we would treat it as interest income for accounting purposes. And then again, in so far, we would have interest income. This would not trigger any limitation in terms of interest deductibility at the level of the Luxembourg company. But obviously here there's the question like, yeah, will the amounts be sufficient? Yeah, but I mean, there are also other ways to manage that. For example, one could, if one has a preference for a Luxembourg company investing into distressed debt, like using like derivatives that could transfer the downside risk and the upside potential from the Luxembourg company to the fund. And then there would be an additional instrument that would only track like interest income. And then like if we would have a loss under this derivative instrument, then this loss should not be treated as interest expense and therefore should not come within the scope of the interest limitation rules. That would be one solution, apart from the treatment as interest income, if that's possible. Another solution might be a securitization vehicle. And here we have a typical situation where a Luxembourg securitization vehicle is owned by a foreign trust or foundation. So the Luxembourg securitization vehicle would issue notes to the investors. And the notes would say like track the profits from the underlying loan portfolio. And here the Luxembourg securitization vehicle, if it takes the form of a Luxembourg company, would be subject to standard Luxembourg tax rules, including the interest limitation rules. So therefore, in principle, we would have a concern. But we have like one exception from the interest limitation rules, which is the standalone entity exception that might exclude this securitization vehicle from the interest limitation rules. And so the standalone entity exception applies if a Luxembourg company does not have an associated enterprise or a foreign permanent establishment. Now, this is something, or this analysis then is a bit more complex than that, because so we have a trust owning then the, say like 12,000 euro of share capital of the Luxembourg securitization vehicle. However, the trust is only the legal owner, but the economic owners are the beneficiaries, which are normally charities. And now if we can make the case that the economic owners of the participation do not own more than 25% in the fund, then the Luxembourg securitization vehicle does not have associated enterprises and therefore comes within the scope of the standalone entity exception. So that would be another solution for this issue. Probably to make a bit of advertisement, I mean, there will be a webinar, say like end of the month, on that very specific topic. So that was it about interest limitation rules, and now moving to the hybrid mismatch rules. So I don't know if there are questions now on the interest limitation rules. Probably we could tackle them at this point in time.
We haven't received something so far, but of course, if someone has a question, feel free to unmute yourself and ask it.
Okay, so no questions so far. That means everything was clear. Very good. Now looking at the hybrid mismatch rules. The hybrid mismatch rules have been provided in the second anti-tax avoidance directive, which provides comprehensive rules targeting hybrid financing instruments, hybrid entities, and hybrid permanent establishment situations that can result in double non-taxation. That means like double deductions or deductions without inclusions. So the rules apply in regard to mere EU transactions, but also in the context of EU and third countries. And probably just a word on what hybrid mismatches are. So like hybrid financing instruments are financing instruments that are treated as debt in one jurisdiction and as equity in the other. Therefore, it can be that then, say like in the borrower jurisdiction, one would then say like, okay, I see a debt instrument and I see interest payments, and interest payments are deductible. And at the level of the recipient, where it's treated as an equity instrument and the income derived from the equity instrument being treated as a dividend and therefore being tax exempt under some kind of exemption. So that would then be a deduction without inclusion. If you speak about hybrid entities are vehicles or entities that are treated as opaque from the perspective of one jurisdiction and as fiscally transparent from the perspective of the other jurisdiction. And this mismatch can also give rise to double non-taxation. And then last but not least, hybrid permanent establishments. Like one example could be what we also saw in the past is like when we have a Luxembourg company having a US finance branch through which then like businesses are financed. I mean, that's not a private equity context, it's the context of multinationals, but just to give the example. And then we would realize interest income in the US finance branch. In the US, one would not tax the income because one would say like, yeah, there's not enough nexus in the US in order to see a fiscal presence. So no taxation in the US, and in Luxembourg, one would say like, yeah, we have a tax treaty with the United States and therefore we exempt the income under this tax treaty. And that would also result in double non-taxation, while the interest payment could have been deductible at the level of the borrower. And so like all these situations say like are tackled by the hybrid mismatch rules provided under ATA 2. Yeah, so the main purpose of these rules is the elimination of double non-taxation. So like everything should be taxed one time. But at the same time, the tax adjustment should also not give rise to economic double taxation. And so there are some mechanisms that ensure that there should be no double taxation. And yeah, these rules apply since say like 2020. So it means like many of you likely came already across these rules. But so like the positive point is that we have today fairly clarity and so like a certain market standard, so that like most of the issues are fairly clear among practitioners. There has also been like an FAQ, so like with frequently asked questions where the most important concepts have been clarified, and this has also been shared with the tax authorities, so that should be pretty settled. And yeah, you find also like in the handout like a comprehensive article on this topic. So the hybrid mismatch rules are extremely complex. And I mean, they really considered like any kind of hybrid mismatch situation. And I mean, some of these hybrid mismatches, I did not even know that they could exist. So they really dealt with everything. And it's extremely complex. So, but so like the positive thing is like in the context of alternative investments, we can mainly focus on like, select 3 types of hybrid mismatch situations. So that would be payments under a financial instrument, a hybrid financial instrument, payments made to a hybrid entity. So that would then likely be the fund vehicle that could be a hybrid entity, or payments made by a hybrid entity. And so one thing that's really important is these hybrid mismatch rules in principle only apply in transactions between associated enterprises. So in principle, the threshold is 50% or more associated enterprises. With respect to payments under financial instrument, this threshold is reduced to 25%. And yeah, 25 or 50% in terms of voting rights, capital ownership, or profit entitlement. Then when we speak about transactions between third parties, the hybrid mismatch rules may also apply if we are speaking about a structured arrangement. That means an arrangement that is meant to produce a hybrid outcome and disadvantage is priced into the remuneration. However, in an alternative fund context, this should not be relevant. So that means like, yeah, we are speaking about transactions between associated enterprises. Yeah, so speaking now about the definition of associated enterprise, yeah, so in principle, like 50% direct or indirect relationship. It could also be alternatively, if one is part of the same consolidated group for financial accounting purposes, that should also not be relevant in the context of alternative investments. Then there is the concept of significant influence on the management. That is a concept that is not so clear, and there's also not much guidance available. But overall, also during the discussions in the different working groups, this concept should only be relevant in specific cases. Then we have the reduced threshold of 25% associated enterprises in case of payments under financial instruments. And this is something say like the 25 or 50% associated enterprise threshold is so important. We will make a number of say like case studies in order to really understand this. And then one very important concept is the say like concept of acting together, where otherwise third parties would be aggregated for the purpose of the related party test, meaning analyzing whether we fulfill the, say, 50% associated enterprise threshold. Yeah, looking now more specifically at the concept of acting together. So in a fund context, because I mean, as we are looking at alternative investments, so here we have a fund and with different investors. The question is like, yeah, is the related the related party test satisfied, and what is the percentage thereof? And because here the question could be if we have a Luxembourg fund and in the form of a Luxembourg partnership, SCS, SCSP. Now one could, or there could be a question mark whether one need to aggregate all the investors in the fund, even if they are third parties, for the very fact that they are investing into a partnership that is managed by the same general partner. So this, say like uncertainty has been induced by one of the examples included in the final report on BEPS Action 2 that provided guidelines on the creation of hybrid mismatch rules. So now what Luxembourg did is in a fund context, and probably I should say like how a fund is defined in a very broad manner. So a fund is defined as a collective investment undertaking that has an investment policy and invest in the capital in accordance with that policy. So that is a very broad definition. So it means we can speak about like, or this includes Luxembourg or foreign funds, open-ended or closed-ended funds, listed or unlisted funds, and regardless of the legal form thereof. So that means very broad. And so what Luxembourg did, and that is something positive in terms of administering this rule, it's the Luxembourg legislature introduced a so-called de minimis rule. So that means like investors that own less than 10% in a fund are deemed not to be acting together in accordance with that concept. And therefore these investors would not be aggregated for the purpose of the related party test. And so if you have investors with less than 10% in a fund, these investors are deemed not to be acting together. And here the burden of proof for the concept to apply would be on the tax authorities. So the tax authorities would need to say, okay, you have here these, say like all 8% investors in the fund. And for this and that reason, I conclude that these are acting together. On the other hand, if we then have investors that own more than 10% in the fund, here an analysis needs to be made on a case-by-case basis, whether these investors are acting together or not. Here, the burden of proof would be on the taxpayer to say the investors are not acting together for this and that reason. But probably one thing also positive, so like also in the official guidance to the draft law, it has been acknowledged that there is no presumption that investors that own more than 10% in the fund would be acting together. So one just need to make the case that these investors are not acting together. Yeah, so now looking at some case studies and probably to anticipate one question like, yeah, how do I prove that investors are not acting together? So probably it's already like in the onboarding documentation that one asked the question, are you acting together with other investors in the fund, so that they could tick the box? And one thing is already the question like, yeah, are these really like third parties, or are there potentially like different investors that are part of the same group? So that is an assessment that needs to be made on a case-by-case basis. So now looking at the first case study. So here we have our Luxembourg fund that invests via Luxembourg Master Co. into real estate properties. And so like the focus here, or the potential issue, is in regard to the debt funding of Lux Master Co. And in particular on the interest-bearing loan that Lux Master Co. Would use in order to grant loans to the subsidiaries. Here, Lux Master Co. would perform financing activities. That means the interest income would be fully taxable, and Lux Master Co. Relies on deductible interest expenses in order to be subject to tax on an arm's length finance margin only. So it means if the hybrid mismatch rules would apply in this case, we would not realize a finance margin of say 0.2%, but we potentially would realize all the interest income, because we would not have any deductible interest expenses. So here it's really crucial for this element and the deductibility of the interest here. With respect to the convertible bonds that finance the participation, again, like here we have like less pressure in terms of deductibility of fixed interest borne by this convertible bonds, because the income derived from the participation should be tax exempt. So there might only be specific situations where we could say like enjoy deductibility of interest in relation to convertible bonds. But even here, I mean, if we would conclude that we have an issue with regard to the interest-bearing loan, it could also have an impact here on the convertible bonds, but to a lesser extent, it's crucial. So now looking at the different investors, so we have investor one, the Luxembourg fund is an SCSP, like a partnership from a Luxembourg perspective that is fiscally transparent. So at the level of investor one, the fund is regarded as opaque. So it means like, and so far we would have a hybrid entity classification. Investor one owns 15%. Investor two, which is, by the way, say like a sister company of investor one belonging to the same parent company, and is resident in a jurisdiction that regards the fund as fiscally transparent. So like in Luxembourg, and so far there would be no hybrid entity classification. Investor two owns 20%. Then we have investor three owning 17.5%. Again, investor three resident in a jurisdiction that considers the fund to be opaque. And then we have investors 4 to 10 that each own less than 10%. Now, if we apply the rules around the related party test and the acting together concept, here we would say like, okay, investors 4 to 10 owning less than 10% in the fund, and these investors are therefore excluded from the aggregation based on the de minimis rule. Investor 1 and Investor 2 are part of the same group and therefore need to be aggregated because they are associated enterprises. So we have 35% associated enterprises. And then we have Investor 3. Investor 3 owning 17.5%. That's more than 10%. And therefore, we cannot rely on the de minimis rule in order to exclude this investor from the aggregation of select shareholding percentages. Here, one need to make the case on a case-by-case basis that Investor 3 is not acting together with Investor 1 and Investor 2. Assuming that this is possible, we only have like associated enterprises of like 35%. 35% is less than 50%, the relevant threshold when we speak about payments to a hybrid entity. And therefore, in this case, the hybrid mismatch rules do not apply. Now, like a slight variation. So now the Investor 1 and Investor 2 have respectively 25 and 27% shareholding percentage. 52% in aggregate, 52% being more than 50%, and therefore the hybrid mismatch rules might apply. Now we have Investor 3 owning 12.5%. If we can make the case that this investor is not acting together with Investor 1 and Investor 2, we can exclude this investor from the aggregation, and investors 4 to 10 owning less than 10% can be excluded based on the de minimis rule. So it means we have 52% related parties, 52% being more than 50%, therefore the hybrid mismatch rules might apply. That the hybrid mismatch rules might apply is, however, not enough for any kind of say like tax consequences. Instead, if now like Investor 1, and then we need to look like, yeah, Investor 1 is resident in a jurisdiction that treats the Luxembourg fund as opaque, while we treat it as transparent. Therefore, for 25%, we have a hybrid mismatch situation. Investor 2 also considers or is resident in a jurisdiction that considers the fund as being transparent. So here we would, first of all, only have an issue as to 25%. That means like, yeah, potentially 25% of the interest paid under the interest-bearing loan granted to Lux Masterco might not be deductible at the level of Lux Masterco. However, the analysis is still not at the end, because now the question is like, what is the tax treatment or the tax status of Investor 1? If Investor 1, for example, is a tax-exempt entity, then the tax status of the investor would discharge the application of the hybrid mismatch rules, because the non-taxation would have anyway occurred at the level of the investor. And so it's not a consequence of the hybridity of the Luxembourg fund vehicle. And that shows also like, yeah, I mean, this analysis is very complex and requires a number of different layers of checks. Now, as a little variation to the previous cases, so you know we have like Investor 1, Investor 2, and a feeder vehicle, like a feeder fund that is also commonly used. And here, the feeder fund would be a fiscally transparent entity. And while the feeder fund owns like 60% in the Luxembourg fund, the investors in the feeder fund all indirectly own less than 10% in the fund. Now, here the question is like, how does the de minimis rule apply to the investors in the feeder fund? Since the feeder fund is transparent, we need to look through and we see the investors behind the feeder fund. And since all of these own like less than 10%, here we can rely on the de minimis rule. And we do not need to include these investors to the other investors. And here Investor 1 and Investor 2, like Investor 2 also owns like less than 10%, therefore can be excluded. So that leaves us with Investor 1 owning 31%, 31% being less than 50%. Therefore, here we are not dealing with a situation where we have like 50% or more associated enterprises, and therefore there's no room for the application of the hybrid mismatch rules. Yeah, here as a variation to the previous case where we had a transparent feeder fund, now we have an opaque feeder fund. In case of an opaque feeder fund, we do not look through to the investors because the feeder fund is opaque and not transparent. And therefore we see like, okay, the feeder fund owns 60% in a Luxembourg fund. And therefore, in principle, the associated enterprise requirement is met. And the hybrid mismatch rules might potentially apply. However, if now like depending on the tax status of the feeder fund, and let's assume it's a tax exempt opaque feeder fund. In this case, the tax status of the investor would discharge the application of the hybrid mismatch rules. So again, we would conclude here the hybrid mismatch rules do not apply. Yeah, and if you look at Luxembourg funds, then there might be say like based on the exclusion principle, a way to say like, yeah, the hybrid mismatch rules might not be an issue in a current fund context. So for example, if one knows that investors are exclusively resident in jurisdictions that treat the Luxembourg fund as transparent, then we know, okay, there is no hybrid entity situation and therefore no room for the application of the hybrid mismatch rules. Another question is, can we exclude that we have like 50% or more associated enterprises investing in the fund? So that could be like, yeah, I mean, if you know, like, yeah, I mean, in the last 3 funds, we always had like, say like different investors from different groups ranging between 5 and 10%. And there's a high probability that in a new fund that would be the same again. One might also exclude the application of the hybrid mismatch rules on that basis. And another element how one could exclude the application of the hybrid mismatch rules is if one targets like only pension funds that are tax exempt. And if the likelihood is very high that this will be the same again, then one can already, based on the tax status of the investors, exclude the potential application of the hybrid mismatch rules. And when the hybrid mismatch rules apply, and therefore that's also very, very important because it's a very technical analysis. And then when one in the end concludes, yeah, there should be a tax adjustment, then the tax adjustment should not be more than is necessary to neutralize the mismatch outcome. So therefore, it's, probably the key takeaway here is it's not an all-in or an all-out thing. It's really like, yeah, we need to analyze, do the hybrid mismatch rules apply? And if they in principle may apply because the related party test is met, then we still have like a number of tests that we need to run in order to potentially discharge the application of the hybrid mismatch rules. And probably speaking a bit about like the experience from say like the last 1.5 years, where we did like a number of ATA2 analysis in regard to existing funds. And it's definitely something that one should be doing because I mean, if then after 5 years one realizes, okay, we had here an issue and then one accumulated issues for 5 years, that's obviously not so good. But what is quite promising based on experience is that, I mean, like in most of the cases that we analyzed, we saw that we either did not have an issue and we could rule out that there is an issue in investment fund, or one could find a fix in order to solve the issue. Yes, speaking about solving issues, we spoke a lot about the scope of the hybrid mismatch rules and the potential issues. And the consequence of the hybrid mismatch rules when they apply is like non-deductibility of interest expenses and other expenses. But in the context of alternative funds, interest expenses is obviously the most important expense category. So if you now look at this situation and we have like investor 1 and investor 2 owning respectively 25 and 30%, and being resident in a jurisdiction that treats the Luxembourg fund as opaque. Here one could consider to have these investors entering the fund via a corporate feeder fund that would typically be then a tax-exempt vehicle, and then we would exclude the application of the hybrid mismatch rules based on the tax status of this corporate feeder vehicle. That could be, for example, Luxembourg or foreign fund vehicle, which is opaque. Then one, in case of new funds, one might consider implementing, say, like a corporate fund. I mean, like over the last years, since the change of the SCS law and the implementation of the SCSP, this vehicle became very popular in Luxembourg as a fund vehicle. So with regard to new funds, one might give a thought about like going back to, for example, an SCA fund vehicle, which is opaque from a Luxembourg perspective and also from a foreign perspective, and therefore there would be no issue with a potential hybrid entity classification. Probably one word about existing fund. I mean, this might be something that one could consider with regard to like new funds, but again, like, I mean, in many cases one can exclude the hybrid mismatch rules, given that it's really like very technical, and one can rule out the potential application of the hybrid mismatch rules based on a number of factors. But then with respect to existing fund structures, some advisors have been pushing forward the idea to convert the Luxembourg SCS into, for example, an SCA. This is something that may obviously trigger a lot of tax consequences in the investment jurisdiction and at the level of the investors. I mean, for example, there could be in the investment jurisdiction a concern with regard to tax losses carry forward, or if you have a real estate fund with regard to a deemed disposal and the triggering of a real estate transfer tax, and all these considerations. And if you then think about, okay, we have like investments in 10 jurisdictions and you need to make this analysis, I mean, that is really very expensive and very time consuming. And therefore, when one can rule out the potential application of the hybrid mismatch rules, it's always better than thinking about a conversion into an opaque fund vehicle. Then another say like potential solution, even so, I mean, I would not advise on that as a common fix, but it's rather like, yeah, if you had an existing fund and if you are at the end of the lifetime, that might be a fix for the last 1 or 2 years. So here we have a Luxembourg fund financing the Luxembourg Masterco, which is the investment platform of the fund. And Lux Masterco uses the loan to grant an interest-bearing loan to the property company. So here, normally we would have like interest-bearing loan finances interest-bearing loan, and we would realize an arm's length finance margin at the level of Lux Masterco. If we now convert the interest-bearing loan into an interest-free loan, we do, for accounting purposes, not realize any interest expenses, but from a tax perspective, we need to perform a transfer pricing adjustment, which would then correspond to the 5% of interest expenses if we remain with the numbers that we mentioned before. So 5.2% of interest income, and then a 5% downward adjustment that leaves us an 0.2% arm's length finance margin. And here, this transfer pricing adjustment is explicitly excluded from the scope of the hybrid mismatch rule. And then looking at the broader picture, so like looking at the investment jurisdiction and so like the Luxembourg investment platform. So the so like like all countries around Europe, if we now have select mainly a European focus with our cross-border investments. So have been, all these countries have been implementing like ATAD 1 and ATAD 2, and ATAD 1 provides for like interest limitation rules that apply to internal and external debt funding. So therefore it might be that the, so like here, the property company incurred already so much interest expenses that the interest expenses incurred on internal debt funding are not deductible anyway. So therefore, one might consider to say like, okay, as I can anyway not deduct any interest expenses, I potentially finance my property company with an interest-free loan, and I do not have then any concern with the interest limitation rules. And then the interest-free loan would be funded by an interest-free loan granted by the fund to Lux Masterco. Here one would also need to be a bit careful, because if you speak about interest-free loans, that could give a concern in some jurisdictions. For example, if you speak about Germany as an investment jurisdiction, if one grants an interest-free loan, one might need to consider a profit on day one and then an expense over the investment period. This can be avoided through like just keeping a small interest rate of at least 0.5%, but that would already then reduce the topic. Probably now, as we speak about like foreign tax law, also a little excursus on the hybrid mismatch rules and the potential application of the hybrid mismatch rules in the investment jurisdiction. Because, and I see whether I find a better slide. Yes. So let's look at this investment structure here. So where the Lux Masterco finances the property company with an interest-bearing loan, and this interest-bearing loan is funded by funds received under a loan granted by the fund. So now, as the investment jurisdiction also implemented hybrid mismatch rules, and there is one rule that is called the imported hybrid mismatch rule. So that means like if the interest expenses incurred by the property company under a plain vanilla debt instrument, no hybridity whatsoever, but the interest income or the interest expenses financed at the level of Lux Masterco payments under a hybrid instrument or a payment to a hybrid entity, then the investment jurisdiction could say like, I deny the deductibility of the interest incurred under the interest-bearing loan on grounds of the imported hybrid mismatch rules. And this is something where one need to be a bit careful, because like the investment jurisdictions will likely be more severe when it comes to the application of the hybrid mismatch rules. For example, the de minimis rule of like less than 10% when it comes to aggregation of shareholding percentages will not apply in the investment jurisdictions. They will likely say like, yeah, if you have a partnership fund, all the investors are deemed to be acting together, and therefore we aggregate them all. And that simply means like we anyway need to analyze everything until the end. That means like, yeah, even if for Luxembourg tax purposes we could perform an analysis that stops somewhere, you know, like if you know like less than 10%, then the analysis stops there. We know we anyway need to analyze further with respect to the investment jurisdiction, because we need to make sure where are the investors resident for tax purposes. So are they resident in jurisdictions that treat a Luxembourg fund in the form of a partnership as opaque? Also, because if that is the case, then we have a hybrid entity, and then we need to analyze the tax treatment or the tax status of the investor. And the tax status of the investor could be tax exempt. Then again, like this tax status would discharge the application of the hybrid mismatch rules. And if it's a taxable investor that also benefits or has a tax benefit from the OPEC treatment of the fund, then there's still a question like, how is the income derived from the fund being treated? Because there are different ways. I mean, if the income is included at the investor level, then again, there's no mismatch outcome to which the hybrid mismatch rules could apply. It could be, for example, that dividend payments by the fund are taxable at the level of the investor. Then there's no mismatch outcome, and also no concern with respect to the imported hybrid mismatch rule in the investment jurisdiction. The income could also be included based on some kind of mark-to-market accounting treatment, or under the application of controlled foreign company rules, where one just includes the income of the subsidiary in the year in which the fund realizes the income. So that means like, yeah, I mean, it sounds complex, it is complex, and one need to analyze, say like the tax treatment in the jurisdiction of the investor and the tax treatment or tax status of the investor itself in order to rule out the potential application of the hybrid mismatch rules. But again, like based on experience so far, and it's probably the time to touch wood, it was always good. Yeah, looking now at foreign funds. Foreign funds might give rise to more complex situations. Foreign funds are very often driven by, say, like US investors, and that means there's a certain complexity induced by, say, like by US tax law and the way investments are structured from a US perspective. Here, if you have a foreign fund might be a hybrid entity. Here, if you see like the PEC instruments are plain debt from a Luxembourg perspective, but could be equity from a foreign perspective. So then that means here we could have a hybrid financial instrument. Also, Lux Master Co. could be treated as transparent from a US perspective. That means like we could see here like a payment by a hybrid entity. So overall, when we have like a foreign fund, the hybrid mismatch analysis is a bit more complex. So now looking again at solutions. Here one solution could be when we speak about the PECs that are like interest-bearing loans and generating interest at arm's length. If we might have otherwise an issue with regard to the application of the hybrid mismatch rules, we could have, and if you speak now about like the fund being a Cayman fund, and then the fund incorporating a Cayman company as a Cayman finance company, and then the Cayman company is subject to zero taxation, and therefore here the payment by Lux Master Co. to the Cayman FinCo would not give rise to the application of the hybrid mismatch rules because of the tax status of the investor, because the investor is tax exempt, and therefore here the hybrid mismatch rules would not apply. Yeah, then here as a little variation, say like instead of having interest-bearing PECs, having interest-free PECs, financing interest-bearing loans. So that means like Lux Master Co. would realize from an accounting perspective, like all the interest income. And from a tax perspective, one would need to perform a downward adjustment, which then would result in the realization of an arm's length margin. And downward adjustments are not giving rise to the application of the hybrid mismatch rules. Again, like this would not be like a long-term strategy, but as over the years, our toolbox have been a bit become more limited than it was like 10 years ago. We should not leave out any option that is there, I think. And then again, the question, do we even have any interest deductibility capacity at the level of the target company? And if the answer to that question is no, potentially one might consider to simply finance the target company with interest-free debt or low interest-bearing debt. We probably still want to keep the loans because the loans are the most straightforward and easy mean to repatriate cash to the fund. So therefore, one should not easily give up the debt funding. Yeah, now looking at the limits of the hybrid mismatch rules, because I mean, I think it became already clear, like, yeah, these are very complex rules and one need to run down an analysis step by step in order to see whether we even come in the scope of the hybrid mismatch rules, and if yes, whether there are means to rule out the potential application of the hybrid mismatch rules. And then from a Luxembourg perspective, we might stop at an earlier stage with our hybrid mismatch analysis. With respect to the investment jurisdiction, we anyway need to run a full analysis. So, okay, so now looking at the limits of the hybrid mismatch rule. I mean, first of all, given that non-deductibility is the consequence of the hybrid mismatch rules when the hybrid mismatch rules apply, the hybrid mismatch rules only apply in regard to payments that are deductible for tax purposes. So like if we have like, say like expenses, interest expenses in relation to tax exempt income, and the interest is already not deductible because of the application of general Luxembourg tax rules, then the hybrid mismatch rules have no impact. Yeah. So then mere timing differences should not play a role because, I mean, if one can make the case that the income is included at a later stage, normally there is no room for the application of the hybrid mismatch rules. So the longer the timing difference, the more one need to think about whether one has arguments for the non-application of the hybrid mismatch rules. Then downward adjustments that are made for transfer pricing purposes do not come within the scope of the hybrid mismatch rules. And then when other EU directives already solve the hybrid mismatch situation, for example, there is an anti-hybrid mismatch rule that has been implemented in the parent subsidiary directive, which is say like the link to the participation exemption regime. So here it is said that in Luxembourg and in the Luxembourg adoption of this EU directive, the Luxembourg participation exemption regime, if we receive income from a subsidiary, the income only comes within the scope of the Luxembourg participation exemption regime to the extent the dividend payment was not deductible at the level of the paying entity. So it means like here, the parent subsidiary directive already solves the hybrid mismatch situation, and therefore the hybrid mismatch rules have no scope of application here. Then, if we can make the case that the income is included at the level of at least one investor, because like we might have a cascade of investors, you know, like a chain of investors, and if we can make the case at least at one level this income is included, then there is no mismatch outcome and no room for the application of the hybrid mismatch rules. And then last but not least, the tax status of the taxpayer. So it might be either like a tax-exempt taxpayer or a taxpayer. Yeah, a tax-exempt taxpayer would be a taxpayer that is resident in a high-tax jurisdiction but benefit from a tax exemption like a pension fund. It could be an investor that is resident in a jurisdiction that does not levy tax, or it could be an investor that is resident in a jurisdiction with a territorial tax regime like Hong Kong, where income from foreign sources is excluded from the tax base, benefiting from an exemption. And if you have these kind of investors, the tax status of the taxpayer is ruling out the application of the hybrid mismatch rules. Yeah, and last but not least, when we speak about double deductions are only a problem to the extent the expenses are not, or say are offset against income that is not dual inclusion income. So in other words, and here it's where it's getting really complicated. So if we consider both the income and the expenses from an entity at 2 levels, it should in principle not be a problem. Only if we have an expense that is deductible at the level of 2 entities, that could be an issue. Yeah, so now a little conclusion, and I think we are pretty good in time. So like 1.5 hours, and we still have some time for questions if there are questions. So overall, the BEPS project has significantly changed the international tax landscape and also the Luxembourg tax landscape. Things became much more complicated, and I think we just saw and appreciate that when the first time you heard about the hybrid mismatch rules, it was definitely too complicated, but there's a comprehensive analysis in the handout that will then help you after the webinar to dig into that. So like looking now at the main pressure areas, if you look at alternative investments, so yeah, the hybrid mismatch rules, it's something like in particular, when we speak about Luxembourg fund, and every Luxembourg fund in the legal form of an SCS, SCSP, we need to do the analysis in terms, and probably just to add that thought, in principle, the Luxembourg tax authorities and the Luxembourg legislator adopted an upon request standard when it comes to providing evidence that the hybrid mismatch rules do not apply. That's very nice, and they wanted to avoid taxpayers having to incur lots of costs on day one. However, one cannot wait with the ATA2 analysis until the tax authorities ask questions, probably after 3-4 years, because if one has an issue, then this issue would accumulate over 3-4 years and becomes a real issue. So therefore, one need to do the analysis in regard to existing funds like now in order to rule out potential issues in Luxembourg, but also in the investment jurisdiction, because in the investment jurisdiction, through the potential application of the imported hybrid mismatch rule, one might also have an issue. Then the interest limitation rules, even so we saw, okay, in regard to financing activities, we do not have an issue. In regard to holding activities, we might have a limited issue, but overall the interest limitation rule should be fine. Where we might have an issue is like when it comes to investments in distressed debt, when the capital gains that are realized cannot be treated as interest income from an accounting perspective. So that is one particular thing that one need to manage. Then, as we will see, say like in a more comprehensive fashion tomorrow, like substance is a topic. I mean, substance was always a topic for Luxembourg as a hub for structuring investments, but since the BEPS project, substance is so much more on the radar and need to be properly managed. And last but not least, transfer pricing and transfer pricing documentation, as we will see on Thursday, is the mean to manage and mitigate potential tax risk in Luxembourg. And so like the Luxembourg tax authorities are becoming more sophisticated and might also be more challenging. And what we are seeing is like now the tax audits that are more common, be it as part of the tax assessment process or like a formal tax audit spanning over several years. The first question that is always asked is like, yeah, provide us with your transfer pricing documentation and your computations, because that is an easy target. So, yeah, and then probably like, yeah, the key takeaway. So what really changed throughout the BEPS project is that what we had probably in the past, that people have been recommending, say like more or less the same instruments and strategies, so like for each and every investment. Today things are becoming much more tailor-made, and one need to look at the different parameters that are relevant and structure investments in a fashion that makes sense for the individual case. And so that would be my final word of this webinar. And And now we can move to questions if there are questions.
Thank you, Oliver. Yes, we have already 2 questions in the chat. I don't know if Nikolai would like to unmute. And
yes, hello.
Hello.
I already wrote my questions, but should I read them again?
No, don't worry. Give me a moment to read the question so that I'm up to speed. Yeah. Okay. I mean, there are like two very specific questions. So probably beginning with the second question. I don't know whether everybody had the possibility to read it. You send it to everyone. So the question around significant influence in the management. I mean, that is indeed a particular issue. So like in the discussion with the tax working groups of LPEA and ALFI, where we developed so like the FAQ on ATA2. I mean, there's indeed some uncertainty, and it relates a bit to more the general partners that might have significant influence. I mean, it's in principle something where one can find some guidance, say like in the sphere of accounting. But again, it's not really conclusive, and one need to see on a case-by-case basis whether this might be an issue. So typically that might be a concern in regard to general partners. Even so, like I would probably not interpret this too broadly, because it doesn't make sense that we on the one hand say like, yeah, because the percentage that is attached to that is approximately like 20% plus, you know, and that is on some international accounting standards guidance based on that. But it cannot be that I say like, yeah, my limited partners have like own like 100% in the fund, but at the same time I attribute the same shareholding percentage partly to the GP, so that doesn't make any sense. So therefore, I mean, I did not see any massive application of this concept. And then the other question related to payments under financial instruments that need to be subject to taxation at standard rate, and then the question is like, yeah, what happens if it's taxed at below the standard rate? Yeah, and indeed, like, yeah, it needs to be a consequence of the hybridity that there is a better treatment, and then the tax adjustment to be performed in Luxembourg would only be what is necessary to balance it. Like, I mean, if they then would save like 5% in the investor jurisdiction, we speak about a 5% adjustment in Luxembourg. But to be fully transparent, I mean, I never saw this applying in practice. I don't know whether, I mean, I would need to construe an example, because again, like touching wood, until now, we could always rule out the application of the hybrid mismatch rules in an alternative fund context.
Okay, so this means that it's rather uncommon in practice to face this.
It's very uncommon, and one would, I mean, I would need to think about whether I even could construe an example with some real jurisdictions and this outcome being for real. So it's rather like also probably like a symbol, like how ATA2 tackles any kind of hypothetical situation that might occur in practice or not. Because I mean, some of these hybrid mismatches, I have been made aware by ATA2 that it could exist in theory.
My question was rather referring to cases, let's say, where the investor's jurisdiction, let's say the US, they have these special rules where they would, for example, subject all the income from group profits in general to a lower taxation. would this fall within the scope or not? Because what personally confuses me is how can I decide that some tax relief is solely due to the way the payment is characterized under the US law, let's say. This was basically what I was referring to with this question, but I don't think that, I mean, I'm aware that there is no guidance on the matter. I just wanted to hear your opinion.
Yeah, no, like my opinion would be, and in particular when it comes to US tax law, the US tax law is extremely complex, and then to make the case like, yeah, I mean, how would that now, say like be treated with respect to the hybrid mismatch rules? If I had a case where I would have a question mark, frankly speaking, I would try to eliminate the potential application of the hybrid mismatch rules based on another element. I mean, for example, like the interposition of an opaque entity that is tax exempt and then end of discussion, rather than putting yourself out in legal uncertainty that doesn't make any sense to bear.
I see. Okay, thank you.
My pleasure. So are there any further questions? I mean, not to say that we didn't have like 2 or 3 intricate already, but just to give you the possibility.
It seems like we don't have any other question for now.
Okay, no, that was nicely landing on time, I would say.
But for sure, if there are any other questions, we can do it in the beginning of tomorrow's session. There is no problem.
Absolutely. Okay, so then if there are no further questions, I say thank you for your attention. I hope you find it time useful spent, and then talk to you tomorrow.
Thank you, Oliver. Thank you all for attending, and see you tomorrow at the same time. Have a nice afternoon.
Bye-bye.
Bye-bye.